Understanding basic accounting principles is crucial for entrepreneurs, whether they run a small startup or a growing enterprise. Proper financial management ensures that a business remains profitable, compliant with tax regulations, and prepared for future growth. While accounting can seem complex, learning key principles can help entrepreneurs make informed financial decisions. Here are 10 essential accounting principles that every business owner should know. 1. The accrual principle. The accrual principle states that income and expenses should be recorded when they are earned or incurred, rather than when cash is received or paid. This principle gives a more accurate picture of a business's financial health by showing revenues and expenses in the correct periods. For example, if a business delivers a service in December but receives payment in January, the income should still be recorded in December. 2. The matching principle. Closely related to the accrual principle, the matching principle ensures that expenses are recorded in the same period as the revenues they help generate. This prevents misleading financial statements. For instance, if a business spends money on marketing in January to attract customers who make purchases in February, the marketing expense should be recorded in February, aligning it with the revenue it helped produce. 3. The revenue recognition principle. This principle dictates that revenue should be recognized when it is earned, regardless of when the payment is received. Entrepreneurs must ensure they recognize revenue at the right time, particularly if they provide services on a contractual or installment basis. Following this principle helps maintain accurate financial statements and avoids misrepresenting income. 4. The consistency principle. The consistency principle requires businesses to use the same accounting methods over time. If an entrepreneur changes the way they record financial transactions frequently, it can make financial analysis difficult and confuse stakeholders. Sticking to one accounting method, such as accrual or cash accounting, ensures that financial reports remain comparable over time. 5. The going concern principle. This principle assumes that a business will continue to operate indefinitely unless there is evidence suggesting otherwise. Entrepreneurs should consider this principle when making long-term financial plans, securing loans, or preparing financial statements. If a business is struggling, accountants may issue a going concern warning, which can impact investor and lender confidence. 6. The cost principle. According to the cost principle, assets should be recorded at their original purchase price rather than their current market value. For example, if a company buys land for $50,000, it should be recorded at that amount, even if its value increases to $70,000 over time. While this principle ensures consistency, entrepreneurs should also consider market valuations when making business decisions. 7. The materiality principle. The materiality principle allows accountants to ignore small transactions that do not significantly impact financial statements. Entrepreneurs should focus on material transactions, those that affect financial decision-making, and avoid wasting time on minor details. For example, recording a $1 pen purchase separately in financial statements may not be necessary, but tracking a $10,000 equipment purchase is essential. 8. The full disclosure principle. This principle ensures that all relevant financial information is disclosed in a company's financial reports. Entrepreneurs must provide clear and complete details about their financial position, including liabilities, pending lawsuits, or upcoming changes that could impact the business. Transparency helps build trust with investors, lenders, and other stakeholders. 9. The conservatism principle. The conservatism principle advises businesses to prepare for potential losses and not overestimate future profits. When faced with uncertainty, accountants should choose the option that results in lower profits or higher expenses to avoid misleading financial statements. Entrepreneurs should apply this principle when estimating bad debts, potential liabilities, or inventory valuations. 10. The objectivity principle. Financial data should be based on verifiable evidence rather than personal opinions or assumptions. The objectivity principle ensures that accounting records are accurate, unbiased, and backed by proper documentation such as receipts, invoices, and contracts. Entrepreneurs should always maintain financial records that can be independently verified to prevent disputes and maintain credibility. Mastering these fundamental accounting principles can help entrepreneurs manage their finances effectively, make strategic business decisions, and maintain compliance with financial regulations. Whether handling finances independently or working with an accountant, understanding these principles ensures that a business remains financially sound and positioned for long-term success.